Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And man, oh man, we've heard a word creeping up in the news recently called stagflation. We're going to talk a little bit about it and how it's one of Michael Burry and Jerome Powell's greatest fears, why that matters, and whether or not we're headed towards it. All right, we'll get to
Great.
it. So this image here, I don't know if you've ever seen this before, but it's a gentleman from the Weimar Republic, which is pre World War II Germany, and that is a wheelbarrow full of cash, right? So I just finished this Holocaust book, and the gentleman in the book was talking about how, he remembers this time period and how you legitimately have to take all the money you made in a day and spend it that day because by tomorrow it wouldn't buy as much as it would today.
Oh my goodness.
Yeah,
That's okay. Weren't they like
yeah.
lighting on fire, money on fire because it was cheaper than firewood or something?
I don't know if it could to that extent. I would be terribly surprised. I mean,
I've
there was
heard
a
that
lot of talks
before.
about how much cash it would take to buy like a loaf of bread at one point in time, but it's
Oh
pretty
my
crazy.
gosh. Okay. That's
Yeah, and I don't
crazy.
know if you remember this after the Weimar Republic. Some really awful things happened. Anyways, so we had the Federal Reserve news conference this week, and Powell reiterated that there is now tension between the Fed's dual mandates. Okay, a little bit. He's not going to come straight out and say like, oh, like the risk of stagflation is rising. That's not Powell esque, right? But he's going to kind of hint at it and dance around it a little bit because that's what he does. He's a Federal Reserve politician, effectively. Um, but that their dual mandates of price stability and you know maximum employment would be kind of come into opposition with each other a little bit. We're going to talk about what
Hmm.
that means and how they are kind of opposite. So this term stagflation, right? You hear it tossed around from time to time. But what does it really mean? This is the Google, see our other video summary, Google AI here. But it's a stagflation term describing economic situation where there's high inflation and slowing economic growth. Okay, so those are things that really shouldn't go together. They should be kind of opposite sides of the coin, but in certain circumstances they can coexist, and it's a scary place to be. The other thing that kind of goes with this, and it's not necessarily part of it, like required, but often goes hand in hand is high unemployment. All right. So it's a tough situation to be in where you have their two sides of their dual mandate here kind of fighting each other. We have inflation being high, but we also have unemployment that's going low often,
Right.
uh, or unemployment going low. Sorry,
Yeah, I know.
misspoke there. All right. So why is it problematic? This is kind of, that two sides of the coin, right? So if you have a job market that is struggling and you want to maintain maximum employment, what do? You do stimulatory effects to the economy. The stimulatory effects to the economy, such as basically printing money or loaning money at a very cheap interest rate. Yeah, see what the Federal Reserve hasn't lowered
Hmm.
their rates anymore. Um, yeah, right. That would be pro-inflationary, right?
Mm-hmm.
And because of the uncertainty regarding tariffs and kind of economic growth right now, basically we're in a place where the Federal Reserve is refusing to do anything until they see something break,
Yeah.
right?
I mean, so people know I'm in TLT fairly heavily. I make a lot of money if they cut rates. I don't think they should have cut rates. I don't know how much more biased I could be. I literally make a bunch of money if they do. I feel like you made
Yeah,
the right call with the data that we have. I mean, I
yeah,
would have done the same thing.
absolutely. I mean, I agree. So this is a nice summary I found about this dual mandate, right? So what is the Federal Reserve dual mandate, right? They basically have two things that they're tasked with doing. That is achieving price stability, which they define as having the PCE close to 2% long-term rate, and then sustaining maximum employment. Now they
Right.
don't give a number like a 2% target for maximum employment because it's a little harder to determine what the actual true ideal employment or unemployment rate would be in an economy, and it varies significantly over time. 2% is not the it's hard to put it down to like an actual numerical value like 2%
Yeah.
like the can
It's
PC inflation.
it's really not so much maximal as it is optimal. The optimal percent, whatever that we could have with the other factors, because they dwindle it down to like these two or three factors, but there's a lot more than that, right? So
Absolutely.
it's just the most that we can have with the situation given. That's all it is.
Yeah. So why does it matter? Like this is kind of a good illustration that they had on their one of their websites as far as what they're trying to achieve. Really trying to go for this bullseye. In fact, it's really they're trying to hone in. And the other thing that this highlights too is that if you notice, both unemployment and inflation are kind of on different axes there. So they are a little bit opposed to each other. It's hard to get into a position where you have a direct correlation with them. Whereas when you have stagflation, you do kind of have a correlation where you have the high unemployment rate and high inflation. That's not typical. You're kind of out here in the fringes, if you will, in your stagflation kind of territory, right?
Yeah.
So in summary, they would be stuck between a rock and a hard place. Yeah, this is Jay Powell just sitting up here on this little rock. Mm-hmm.
That's terrifying. But all right.
Yeah.
I wonder if that's a real photo.
Yeah, I think it's a real photo. The thing I wanted to highlight from this, so all right, now we're going to look at some of the data points and whether or not we're headed towards it. This just came out this week, and this is the first quarter 2025 GDP for the U.S. All right, and if you notice, it's below zero here, so it's a negative number, meaning that we actually had a little bit of contraction in the U.S. economy in the first quarter of 2025. Right, so that would be a point towards decreased or stagnant growth of the economy, and recession can also be included in that. And then now we have to kind of look at the other side of the coin here. What is our inflation and jobs data doing in terms of deciding whether or not we're headed towards a stagflation environment, right? So PCE, all right, we've been talking about this for quite a while, but this is the Federal Reserve's preferred inflation index, right?
No one gave a crap about this before COVID, by the way, at all. This was this was not like a big deal. Now it's like huge every time it's released.
So if we look at the 12-month, kind of rate here, basically, we have come down significantly closer to this 2% target. This is their target right here. You do notice that the core PCE, this blue line, is above the kind of headline PCE, and it has been now for a little while. In the beginning of the inflation spike, it was the opposite, where the core was a little bit lower. But now that we've had, kind of decrease now in energy prices, it's been on top of the headline number for a little bit. But still hovering here. It's hard to really get close to the 2%. We've been kind of like, we made some good progress initially, but we've had a while now where we've been just like kind of hovering in this mid 2 range without any significant sign that we're moving right to the 2% target. We're close, but hard to get right to it from a nominal perspective.
And you have the uncertainty of tariffs happening at the same time. I should adjust my statement. It's not that no one cared about PCE, but if you look at the minute it's released, there's now highly volatile moves in the stock market, which pre-COVID, the market didn't care as much. But now people are literally waiting for the numbers. Whereas before it was like, oh, okay, it's it's whatever it is. Now it's you will see a SPY or a Qs spike the minute it's released, and it will jump sometimes the full daily range. It's insane.
Yeah. It's certainly like I said, the Federal Reserve is very, very consistent about saying that that's what they care about, and the market has heard that message and now basically put it into play. Where the moment that number comes out, they react to it. This is what you're saying here. So this is unemployment. This is kind of one of the other, other side of their dual mandate, and the other thing that can be affected during stagflation. We have seen a slight upward trend here for a little while. Remember, Dylan's done a couple of videos where we've talked about how we hit that SOM rule. I'm going to show you that chart here in a second. But it hasn't had the historical kind of result there where we hit that SOM rule and then all of a sudden we had the massive spike in unemployment. It still hasn't come to fruition. I think if we do see that, that's when you'll finally see the Federal Reserve react. But the most recent jobs data we had came out this week here. 4.2% is now the headline number as far as unemployment rate in the U.S. Slight uptick, but nothing significant as of yet. I stole your chart, brought it over, and added the most recent monthly data to it. As we talked about here, so the SOM rule is that 0.5% increase in unemployment rate. Once it hits that number, usually there's like a big spike up here. And if you look at these red numbers, as Dylan has indicated in the past, that's when you saw like that really take off, right? as far as the timing there. There's only two that have been lengthier than the one we have right now, so it's possible we still have an opportunity here for the sun rule to be engaged, but we're becoming further and further away from the historical pattern here, where it's usually within like 1 to 3 months of when it's hit that you get that spike.
So the red was, it was a little bit arbitrary. It was just, that's what I put as a point 0.4 jump in 1 month or more. So even the ones like 2001 where there is no red, it still went up dramatically. It just went slow. So we have been going down. Actually, we're actually
Yeah,
lower than we were from 4.3 to 4.2. But in 2001, went 4.5, then 4.6, then 4.9.
yeah,
2 months later, 5.3. So it went up consecutively. It just didn't have a point 0.4 jump. So
yeah.
in my eyes, we've already failed, because at no point in history have we ever had something like this. The closest was 1981, but it still jumped a lot. So
Yeah, and you were starting from a pretty higher, much higher
yeah.
baseline. So, yeah, I mean, it's definitely interesting. I think that as we continue to watch this, right, PCE data and unemployment, or what the Federal Reserve is watching, it's going to be a spike in the unemployment data that's going to possibly trigger a Federal Reserve rate cut. But short of that, I don't think they're going to do anything.
Yeah, I mean, I don't think they should. There's no gain. I know President Trump wants him to, but just because the president wants that doesn't mean that, that should happen. I
Mhm.
don't see the benefit of it happening too, or the risk to reward is not worth it. If you do it too early, only bad things can happen. If you
Yeah,
do it too late, it may be uncomfortable for the time that you were there, but you can fix it. So to me, the risk to reward is, it's kind of a no-brainer, especially when you have
yeah,
variables of the tariff situation. Just wait. I would do the same thing. Once again,
we
I make a lot of money if he does. But I would say
yeah.
don't do it. So
Absolutely. Well, the other kind of point too is like, right now the first shipments coming to the US will have the full maximum Chinese tariffs on them. Do we actually see inflationary pressure from that? And do when we start to see PCE trend up? That's the major question right now.
yeah, I mean, the tariffs have changed like 3 times since that happened. I mean,
Yeah.
so it's like it's such a fluid situation. It was like 100%, like 150. Now I just saw a thing is like, oh, we might go down to 40. So it's like,
Yeah.
okay, all right.
Well, it's a real question. I mean, it's definitely a possibility that we end up in a stagflationary environment where, like I said, we've
Yeah,
had
it's
one now
terrifying.
negative quarter of GDP. Do we throw in another negative quarter of GDP, and then also have maybe a little bit of increase in inflation here because of these tariffs? So it's become a very real possibility that we end up in this stagflationary environment. I hope we don't. I still think it's less likely than the alternative, but it's become possible, right?
Yeah, I mean, I think none of this matters because AI is going to have all of our jobs in 10 years. So, but
Absolutely.
yeah, let us know what you guys think.
Catch you next one.